Welcome to our second session in investment and portfolio management. So we're going to look at what is called HPR, which is a holding period return. We'll also look at HPY, which is the holding period yield. So in investment, we must be privy to this important topic where we're going to look at investors who, or perhaps potential investors who want to assess the potential returns should they invest in a portfolio. So there are two key concepts that will provide insight in knowing or allowing the investor to gauge the profitability of the investment over a specific period of time, accounting for both the capital gain, accounting for the income they are yet to receive from the investment. And so in this session, we're going to look at what is called the HPR, the holding period return, and the HPY, which is the holding period yield. So when we're discussing the holding period return, what are we talking about? Now, this is a very fundamental metric which calculates the overall return on an investment over a given period. So this HPR usually considers not only the increase or decrease that an investor will incur in an investment value, but it will also account for any income that is generated during the period, such as the dividends, the interest, and other gains. So if we're going to look at the formula for the HPR, it is given by the final value of the investment minus the initial value of the investment over the initial value of the investment. So it's definitely a ratio of the difference between the final and the initial payment relative to the initial payment. So this will give us a value that is expressed as a percentage of an increase or a decline in the investment at hand. On the other hand, when we are looking at the holding period yield, we basically are looking at more like the same thing. It's very closely related to the HPR, but this one is expressed as a percentage of the initial investment. So here, it involves us having a clear representation of the return on the investment, considering the initial amount that was invested. Now, that is the baseline. So the formula for HPY is the answer we got, which is a HPR divided by the holding period. Now, this formula, holding period, actually refers to the time frame for which the investment was held. So when we divide the answer we got, which is the HPR, by the number of holding periods, whether in years, in months, in other units, as weeks or days, the HPR will give you a percentage, and this percentage will demonstrate the proportion of returns on the initial investment that was initially put in each period. So if we're going to annualize the HPR and HPY, investors would want to compare their returns across different types of investment options. And this, in this course, investment analysis will give us an overview to analyze the annualized performance of an investment. So to achieve this, annualizing these metrics becomes very necessary. So the formula that we'll be using for HPR and HPY will be as follows. So the annual HPR will in this case be 1 plus HPR to the power 1 over the holding periods per year, then minus 1. Then when you are calculating the HPY, it will be the annual HPR divided by the holding periods per year. Now these formulas that we're going to use will allow the investors to calculate an equivalent annual rate of return by considering the compounding effect over time. So I'm going to take you through a few examples, but just to conclude what I've just explained here, when we're discussing the HPR and when you're discussing the HPY, these are two crucial concepts. They're crucial concepts that investors today would be interested to know, to give them a holistic overview of the investments over time for both capital gains and incomes generated during a specific period in time. On the other hand, annualized versions of these metrics will enable investors to have comparisons and evaluations over different investments, helping investors to make informed decisions about their financial ventures. So suppose you have an investment of 3,000 at the beginning of the year. You invest 3,000 at the beginning of the year. It's supposed to be 300 at the beginning of the year, and you get back 330 at the end of the year. What is the HPR and what is the HPY? So this one is easy. Remember, I said it is the initial from the ending value over the beginning value. So we actually it's correct as it is 3,000. So we invested the 3,000 at the beginning of the year. And at the end of the year, we get back 330. So we want to calculate the HPR and HPY. So ending investment was what? 330. And we started with 3,000 over 3,000. So in this case, we are getting a percentage in a loss. So when we subtract 330 minus 3,000 over the 3,000, we're getting negative 89%. So this is what we call our HPR, holding period return. Holding period return. So we are also being asked to calculate, we are told to also calculate the HPY. So how do we calculate the HPY? So in this case, I've presented two scenarios where we are calculating HPR over HPY with the ending value being 330. And here we're also going to calculate HPR against the HPY, where the ending value is taken to be 3,000. So suppose the vice versa happened. We actually started with 3,300, ended with 3,000. So our HPR in this case would have been a progressive 10%. Progressive 10%. I hope we are together. That's clear. All right, let's look at another question here. Suppose that during the past 3 years, you have owed 100 shares of William Pharma Corporation, a commercial biotech firm. During the period, the company's stock price has been as follows from 2017 to 2020. So our purchase price initially being 135, growing to 144, 167, and dropping to 154. So we are being asked to calculate our HPR and our HPY. So assuming the company pays no dividends on its stock, we are being asked to determine, based on the information above, the HPR for the investment of 3 years and the HPY for the investment of 3 years. So to start with, HPR refers to the total return that an investor will earn on an investment since they started. And an annualized HPR will derive the annual return earned on an investment over its life. So we'll start with the beginning and from the ending amount. So the beginning amount here was how much? 135. The ending amount was what? 154. So what we're going to do here, we're going to subtract 154, which is the ending amount, minus 135, the beginning amount, over the beginning amount, which is 135. So here there's a progressive increase of 14.07%. Then secondly, we are going to analyze the HPR as follows. Remember the formula I gave earlier. It is 1 plus HPR to the power 1 over the periods that we have, minus 1. Now, in this case, we have 3 years. Now, these 3 years are compounded semi-annually. So, depending on the period we're talking about here, it will affect our period. If it's compounded semi-annually, we multiply the time times 2. If we are dealing with quarterly, multiply the time by 4. If it's just annually, multiply the time by 1 as it is. So in this case, we haven't been told whether it's quarterly, whether it's annually. It's just annually. We're not told that it's a quarterly basis. So annualizing it, actually it's annualizing the holding period return, it's 1 plus HPR the power 1 over n minus 1. So our HPR in this case was 14.07, 1 over 3 minus 1. So this gives us 1.0449. So when subtract 1 from there, we're going to get 4.49. So this is what we call the annualized holding period return. Annualized holding period return. So that is what we have here as 4.49. Are we together? Any questions so far? I hope this is clear. So with what has been explained so far, there's some homework for you to do. You are being given a student at Unilas who commits a 500 an investment worth 800 after a 2-year holding period. So you're being asked to calculate the HPR and HPY, then you annualize them. And also you're given a series of payments for 2 investments, A and B. So we're seeing the growth 90 to 94, 70 to 72, and we're being asked to calculate the HPR and HPY. So I will require this work as soon as it's possible. Thank you so much for your time.